We start today's market talk. In the real world, trees don't grow to the sky. When something is new, the competition and disruptive technology have yet to arrive. Merit may be there, but if it's overestimated, it can get overpriced, only to evaporate when reality sets in. What we are witnessing now is a natural settling of valuations that had grown somewhat stretched. So, at these times, focus on fundamentals, keep your investment thesis sound, and invest for long term. Market outlook. Over the course of the week, we had some idea of what Trump was trying to do. Behind all the tough talk and aggressive posturing is the imperative to preserve America's hegemony and its economic dominance. So, in its speech to the World Economic Conference, he invited businesses to set up shop in US, offering them low tax rates. He said he wanted lower oil prices, lower interest rates, more oil drilling, lower business regulations, higher spending on defense by NATO partners. He announced a $500 billion private sector investment initiative in US AI infra. He said he may use tariffs to in order to force concessions from other countries as a threat. Right now, India is off the investors' radar as there are worries about a slowdown in the domestic Indian economy. Hence, we need an extraordinary budget for these extraordinary times to make India great again. Uh, if it reiterates its commitment towards investment and capex, boost consumption with much needed tax breaks while sticking to fiscal consolidation, it will re-establish the long-term potential of India's economy and stock markets because 6.5% GDP growth is not good enough to ensure jobs for the millions joining the workforce every year. For reference, 2021 budget speech had everything, but there is a big difference between announcements and their implementation. So what we need is clear-cut timelines for privatization and asset monetization, which should be specified in and implemented. Now, talking about US, they had a strong week boosted by business-friendly announcements from Trump. He refrained from announcing tariffs on other countries. Sentiment was boosted by good results from Netflix. The Stargate project added to the bullishness. Focus is now shifting to the monetary policy as Fed's first interest rate decision for the year will be announced this week. So coming to the US yields, it had corrected from the high it made to around 4.8. But if you see here, it is still above the 61% retracement. So it has to break this 4.5 level for a clear downward trajectory. Otherwise, it tends to bounce back. And now again, it has bounced back last week. And in case the Fed is found to be slightly hawkish, then the yields are expected to go up. Or in case the market finds that the Trump's announcements are inflationary. Similarly, the dollar index also corrected, basically because no tariffs were announced. So the dollar, which had priced in putting in of high tariffs on other countries, etc., corrected, but it can reverse its position very quickly. Brent crude also corrected around 3.5% based on the premise that the sanctions on the Russian oil is going to be reduced, and the Trump is going to ask the companies to start exploring more oil and gas in the US. Gold continued its trajectory. It took support at the rising trend line after the fall and then has now gone up. And once it breaches the last all-time high at around 2,800, it can head to $3,000 level. Copper was consolidated last week, and now based on demand and supply issue, it should go up or down from here. Bitcoin continued its upward trajectory, was up 3.37% last week. And with the crypto favoring policies by the current dispensation in the US, this this uh, this is expected to do better. Nasdaq continued the upward trajectory and it is in that rising channel. So it was up 1.55% based on good results from Netflix. Dow also performed well, was up 2.15% based on the expectations that the policies of Trump and the new dispensation would be business friendly. India VIX went up to 70. So it is precariously poised right now, and it has led to higher volatility in the market. So it has to correct substantially for the volatility in the market to come down. USD INR, which had gone to 86 plus point 0.5 plus levels, corrected from the higher levels, and it has now come to 86.14, along with some interventions by RBI, etc., and the weakness in dollar. So we'll have to see further where it goes from here, but the trajectory is upward only for this. Nifty 50 last week, it corrected around 0.48% and it is now below the 50 EMA. So it is looking pretty weak as such. So it has to climb above these averages for it to gain strength. On the daily chart, so if you see this kind of a pattern which is being made from the five-wave structure of Elliott wave. So we have done three waves. After a rise up to say around 23,400, it is expected to correct to around 22,500 or below from here. So we'll have to see what happens and how the budget is taken by the market as such. Hourly chart, so if you see here, uh, on 20th, that is Monday, the Nifty rose, but it corrected big time on 21st, made a low below 23,000, then rose a bit, went up to 23,350 on Friday, and then corrected at end of the day on Friday, back to the 2350 level. So it is stuck in this range right now of 23,400 on the upside and 22,950 on the downside. This is the January option data for Nifty. So if you see here, there was a put unwinding on 23,000. So that means people are scared even for holding on to puts of 23,000. And there are a lot of people who are still stuck and in the money puts at each higher level. And now, in case 23,000 breaks on the Nifty, uh, they will bring the index down because right now the time value has finished, so the theta decay has taken place. So these positions are like taking up uh, long positions in the future. Hence, this makes these people very vulnerable, and every rise they will get sold. Or otherwise, in case the market falls, then they will be squaring off their positions because otherwise they will take in bigger losses. There is adequate call writing, which will keep putting pressure on any rise in the market. Nifty Bank corrected around 0.36%. It had gone up to the low of 42,800 last week, so it tried to rise, but then it was sold off. So we'll have to see what happens. It's again looking weak. On daily chart, it has made a head and shoulder pattern. So the the distance from the neckline is approximately 4,500 points. So technically it can go down from 49,500 or another 4,500 point to around 45,000 level. So this 48,000 level is critical for the Nifty Bank. Now HDFC Bank tried to go up, but after results it got corrected. It had gone up to 1680, but it got corrected and now again it is back at the same range. So we'll have to see where it goes. If it breaks this 1610, then it will head to this 1520 level or the support it had taken last time at 200 EMA on the weekly charts. Reliance had risen up, then faced resistance along from the 50 EMA around 1300 plus levels and then has corrected. So we'll have to see whether it can hold 1200 or if it breaks this, then this will take the Nifty down. Now, last week, one of the accidents was Dixon. It was a leader of the this bull market from last year, from March, April onwards. It had really, from 4,000 odd levels, it had it had risen up and had gone up to 19,000. And there, from there, after the results, it corrected and sold off with large volumes. So this level of 15,650 is very critical. If it breaks this level, then it is expected to see lower levels on profit booking, etc. Because a lot of people are sitting on a lot of profits. The other accident was Zomato. This is a weekly chart. So if you see here, from the 300 levels where it had gone up to, from 40 odd levels in the last 1.5 years or so, it has corrected and has come down to around 200 odd levels, and then it rose. So this level is critical. If it breaks this 200 level, then it will go to this 186 support. Whether if this holds or not. It also came down with large volumes based on slightly weaker than expectation results. Nifty Midcap 100, it broke the support here, which was the high of the election day, where it had taken support last week, but it broke through that, and this is what is causing pain. Similarly, in the small cap index, similar charts, again, it has broken this support level. So much lower levels are expected as the people are sitting in a lot of profits in these small caps, etc. Now I'll cover three stocks. First is APL Apollo Tubes. Its performance bounced back sharply post second quarter, which was one of the worst quarters in the recent years, driven by severe inventory losses. Revenue was 6% higher than estimates at 5,430 crore, 30% plus and 14% plus year on year and Q on Q, driven by high sale realizations. Total sales volume were at 828 kiloton, plus 37% and plus 9% year on year and Q on Q was in line. EBITDA per ton improved 129% Q on Q to rupees 4,173 per ton, in line with estimate of rupees 4,080 per ton. Fourth quarter performance is expected to be better with EBITDA per ton target of rupees 4,500. Value-added sales mix stood at 56% for third quarter FY25 versus 55% Q on Q. So that is helping the EBITDA. FY25 sales volume guidance maintained at 3.2 million tons. FY26-27 sales expected at 4 million tons, 5 million tons respectively. FY27 EBITDA per ton targeted at over rupees 5,000 per ton. Raipur and Dubai plant utilization stand at 56% and 58% respectively. Net debt reduced to 300 crore from 300 crore sequentially. So if you see their quarterly results, net sales were up 30%, 6% above the expectation. Higher realization helped them. EBITDA also was up 23%, 2.3% versus above higher than expectation. Sequential rise in realizations on better product mix and lower discounts. EBITDA margins were though lower. They came at 6.4%, but higher from the second quarter, nearly doubled from there. Profit before tax was up 27% and up 302% year Q on Q. Similarly, with profit after tax was up 31% year on year and 303% Q on Q. Operating poor performance extrapolated to PAT, and EPS came at around 7.8 for this quarter. Now, from it has grown its volumes. So the volumes had grown to 828 kiloton in this quarter from 758 in second quarter and 603 over last year. EBITDA per ton though has declined, though it has improved from Q on Q, but has declined by around 500 rupees per ton, and which is impacting the revenues and the margins. It is expected to do around 25,000 sales, net sales, 25,000 crore net sales in this year, with growth of around 18 to 20% over the next 2-3 years. EBITDA is also expected to grow around 40 odd percent, and net profit is expected to grow around 50 to 60% over the next few years. One of the key reasons would be lower interest cost. As they have reduced their debt, so the interest cost will reduce, which will directly help their profits. EPS is expected to be around 41 in FY26 and 59 in FY27. So taking a mean of around 50, it can easily trade at around 35 times, 35 to 40 times in good markets, but it should first stabilize. Return on assets has improved, and the growth is good, and so PEG ratio is around 0.6 based on the expected growth right now. So this stock had gone up to 1800 odd levels. Then it corrected because of second quarter poor results expectations. Right now, it is consolidating. So it has taken support at this 100 EMA on the daily or weekly chart, sorry. So every dip to this 1430 odd levels is a buying opportunity for a target of approximately 1800 to 2000 over the next 1 year, and as the market conditions improve. Next stock is Coforge. It reported better than expected revenue growth of 8.4% Q on Q in constant currency terms versus estimate of 4.5%. Management is confident of achieving robust and sustained growth in calendar year 25, supported by a strong order book, a solid pipeline, and the realizations of merger synergies. Acquisition and integration related expenses are set to decline further in fourth quarter and are likely to largely conclude by then. Deal momentum continues to remain strong. The company reported fresh order intake of USD 501 million versus USD 515 million in second quarter, and the last 8 quarter average is around USD 451 million. So the order intake is improving. Management expects the travel vertical to remain resilient and grow despite the ongoing inflationary pressures. In banking and financial services, demand continues across multiple micro areas like operational resilience and regulatory compliance. Both BFS and insurance are poised for margin and revenue growth next quarter as the 50 basis point impact from furloughs this quarter is expected to reverse. Among geographies, America was up 5%, 9%, sorry. Europe, Middle East, and Africa was up 8.5%, while rest of the world was down 5.3%. So if you see their quarterly results, they did approximately 397 million USD. That is a growth of 7.5% Q on Q, which is strong. So we have seen they were getting orders of around 500 million and doing around 400 million. So that means the order book will increase. Revenues in UP terms grew 8%. EBIT is up 21%. EBIT margins are also up 10.8, but vis-a-vis last year, it has reduced because of acquisitions and integration. So EPS is up 4.3% Q on Q, but down 24% year on year. Now, as per future, this stock is expected to do around 222 or EPS in FY26 at 40 times at around 8,800 to 9,000 should be a fair price for this stock. Only thing is that you have to watch this performance because these performances can change very quickly based on order book and execution, etc. So if you see here, operating metrics, Q on Q growth around 7.5%. Geography wise, America is 56%, and Q on Q growth wise, America has grown 9% and Europe grew 8.5%. Vertical breakup, BFS is around 27, while insurance is 18, and travel and transportation is 18%. Q on Q growth wise, so if you see travel and transportation and hospitality was the best, 7.5%. Client composition for top five has reduced, which is good, so it is becoming more diversified. New client addition is 14, with approximately two clients in USD 10 million category added. Executable order book over the next 12 months has improved to 1365 million. So there is a revenue visibility now, at least for 2 to 3 quarters. Employee metrics, total employee count has improved, which is decent, and attrition is around stable at around 11.9%. Revenue growth was ahead of expectations at 8.4% Q on Q in constant currency terms. Executable 12-month order book remains strong. EBIT margin at 11.8, flat Q on Q and below our estimates. So if you see, this stock took off in May this year, and from 4,500 has gone up to 10,000 levels then it has corrected, and after the results, it has again bounced back. So don't chase the stock. So look for dips to around these levels of around 20 EMA, 8,300, 200. This should be the level to accumulate the stock on every dip, and then wait for uh, the market to give you profits from here. Gravita India expansion plans coupled with regulatory tailwind and global focus on recycling is helping it deliver revenue, EBITDA, CAT, CAGR of 56%, 25%, and 33% respectively over the next 3 years. It expects to be zero gross debt by end of FY25. It raised 1,000 crore through QIP. The outperformance was driven by lead aluminum volume growing 27%, 92% year on year. Domestic availability of scrap improved 50% year on year. Increase in domestic sourcing of scrap to 44% resulted in lower EBITDA per kg of rupees 19, down around 14%. So that helped their margins. 80 crore capex for increasing FY24 capacity by 67% to 505 kilo metric ton per annum on track. Pilot plant for lithium ion and rubber recycling in India is expected to commercialize by first half FY26. Management has guided for FY24-28 volume CAGR of 18-20%, 40% and 60 to 70% in lead, aluminium, and plastic. So the aluminium and plastic segments are expected to grow faster. Maintain FY24-28 revenue profitability CAGR guidance of 25 to 35%. Management maintained its long-term guidance of delivering 25% revenue CAGR over FY24-28 and improving non-lead revenue mix to 30% by FY28. Post-implementation of end-of-the-life vehicle policy, the registered vehicle scrapping facilities will be driving force for supply of scrap batteries to the recycler in the next 3 to 4 years. Mundra pilot plant for lithium-ion recycling and first rubber recycling plant in India are on track to start commercial production by first half FY26. So coming to their quarterly results, for this quarter, year on year, the revenue was up 31.5%. For 9 months, vis-a-vis last year, this was up 23%. Expenses have gone up 33%. So EBITDA was only up 14%, and margins have come down from 11.8 to around 10.3 because of lesser realization in lead. Profit before tax was up 20%, and reported net profit is up 29%. So EPS was also up 29%. Segment-wise, if you see here, revenue-wise, uh, the growth is more in aluminum versus lead and plastics. Geographical revenue mix, domestic and international. Domestic has increased and international has reduced slightly. Value added uh, uh, product revenue has also come down a bit, and domestic scrap collection by Indian plants has increased by nearly 800 basis point. Overseas capacity has improved by 200 basis points, and capacity utilization is up around 1400 basis points, so which is helping overall revenue. Segmental volumes for aluminum was up 91.9%, so which helped. This is year on year, and realizations was up year on year for aluminum by 23.3%, while down for lead. EBITDA, including hedging gains oblique loss, was up 129% for aluminum and down for overall EBITDA was down for lead. That's why they are transforming to other segments other than lead. So now if you see segmental EBIT was higher now, though it is value-wise, lead is higher, but the growth-wise, aluminum has grown 262% and plastic has grown 93%, though the base is less. EBIT margins have also improved for both aluminum and plastics, and EBIT mix is they are trying to now reduce the quantum of sales mix of lead and trying to increase aluminum and plastics and others so as to improve their margins. So if you see in FY26, they are expected to do around 5,000 odd crores, 5,200 crores. So it will help what will actually help would be the interest expenses will be zero. They will retire all their debt in FY25. Hence, adjusted EPS would be around 60 odd in FY26 based on saving of the interest expenses. And revenue is expected to grow around 25% CAGR, EBITDA around 30% CAGR, and PAT around 40% CAGR over the next 2 years. So ROE, etc., is coming down because lead realizations are decreasing. Similarly, ROC is also coming down, and EBITDA margins are also declining. So they are also, that is why they are uh, sh- transforming their business to other aspects like lithium ion, aluminum, and plastics. So if you see this stock, it was floundering at around 800, 900 levels because of Red Sea issue, etc. So they could not procure the lead, etc. Once they have changed more into domestic procurement and the Red Sea problem have reduced, the stock shot up, went up to 2600 odd, and then it has corrected. But based on decent results, it has recovered. It has not corrected much. So 2000 should be a decent level to accumulate this stock. And this can give approximately 2600, 2800 over the next year or so. I have finished. We'll take questions now.